As we enter the third week of lockdown, many of us are wondering for just how long can UK businesses survive without benefiting from their normal levels of productivity? We have been investigating the level of cash reserves held by FTSE 100 companies to establish the number of days they can continue to cover their operating expenses, regardless of any future sales. Companies with a higher number of days cash in hand will be able to operate for longer without having to incur additional debt or raise further funds from shareholders. The news is positive. On average, FTSE 100 companies could operate for a total of 618 days without any further sales. In other words, they will be able to cover their operating costs for roughly 20 months using cash reserves alone. The ability to be able to fund over 18 months of operations without any new sales gives businesses breathing room in terms of how they manage their expenditure. Of course, this is without taking into consideration the significant levels of government support that has been announced. This only strengthens positions further, as for many, their largest expenditure will be salaries. And with these being covered by the government, their cash reserves will be less depleted than they otherwise would have been. For investors, this paints a very different picture from what we saw back in the 2007-2008 financial crisis. Back then, companies were operating with unsustainable levels of debt, generally they had weaker balance sheets, and with less stringent capital adequacy regulations at the time, many had small cash buffers. Clearly, some important lessons have been learned. The takeaway for investors is that on average, the UK's largest companies are in good shape to cope with the economic storm. Using the average days cash in hand as a metric to assess the financial strength of FTSE 100 companies suggests that the vast majority went into the crisis in a position of financial strength, but none of them have been immune to panic selling. Therefore, it certainly does offer the opportunity to buy shares in quality companies at significant discounts. For retail investors, often psychology will get in the way of buying into stock markets during times of economic stress. A good way to look at this is if you were offered a new Ferrari at a 50% discount, you'd probably jump at the opportunity. On the other hand, if you were offered a share in a company at a 50% discount, you'd probably question why it had fallen by 50% and may be averse to buying. The Ferrari hasn't become a bad car because it's available at a discount, and the same is true of certain businesses. But the caveat is it's important to be selective. Our job as investment managers is to take the emotion out of the equation and actively identify both the short-term and long-term opportunities and take advantage of these accordingly. So, in general, the UK's largest companies are in good shape to weather the economic storm, and investors now have the opportunity to buy into markets at significant discounts. I hope you've enjoyed watching, and if you have any questions regarding your own investments, please do get in touch.